Hello friends, a very warm welcome to my channel. In this video, we are going to talk about Varun Beverages, which is one of the best performing companies which India has produced in the last couple of decades. And it has created massive wealth for its shareholders over a period of time. This was selected in a recent poll on a Telegram channel. You can also watch our videos in Hindi. There is an option in the settings button where you can choose the language and change it to Hindi and watch it. If you are new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos that I have uploaded. Here is a small disclaimer as per SEBI regulations. You can pause the video and read it. This will be the flow of our discussion. We'll discuss the business model of Varun Beverages in brief. We'll look at the chart in the last 5-10 years. We'll understand the financial performance in the last 5 years, the reasons why the stock has given such a sharp correction from the top, the outlook of the management going forward, the valuations of the stock at these levels. We'll understand the risks of investing in this business and then form an overall view. So Varun Beverages is one of the world's largest franchisees of PepsiCo outside the US. So it does the manufacturing, bottling and distribution of all the beverages of PepsiCo in India. More than 90% of the business that PepsiCo generates out of India from beverages is done by Varun Beverages. So in a way, both of these companies, PepsiCo as well as Varun Beverages, are closely connected and dependent on each other for their business in India. That's why they have a very long-term relationship going on. Now, other than India, the company is also taking franchisees of other countries, especially in Africa. And they are also getting franchisee for snacks along with the beverages in countries outside India. Their present license is valid up to April 2039. So there is sufficient headroom for growth for the next 10 years or so. Nepal, Sri Lanka, Morocco, Zambia, Zimbabwe, South Africa. These are a few of the countries wherein Varun Beverages is already doing business outside India. Right now, the export share compared to the entire revenue is small. But going forward, export business is growing faster than the Indian business. They have 50 production facilities, 38 in India, 12 abroad. Along with the manufacturing of the main product, that is beverages, they are also doing backward integration for manufacturing their own packaging material like preforms, closures. And they have recently done a joint venture with a Sri Lankan company to manufacture their own Visi coolers. So the entire range of products which are required for the storage and distribution of the beverages is internally getting manufactured in Varun Beverages. They have 130 plus depots in India, more than 2,800 distributors, and more than 10,000 vehicles running around carrying their products. So for a new company to enter this business and replicate such a deeply penetrated distribution network is very difficult. So that is the moat of this company. And that's why Varun Beverages is the largest franchisee in India. And PepsiCo cannot replace this company overnight with another new vendor. They have more than 1.15 million Visi coolers installed in more than 4 million retail outlets. Carbonated drinks generate about 75% of the revenue. Non-carbonated generate about 7%. And water generates about 18% of the revenue in the beverages segment. 72% of the revenue comes from India and 28% outside India. So as and when the company felt that the growth in India is coming near the saturation, they have started diversifying outside India, which is a very clever move by the company. This is a broad understanding of the relationship between PepsiCo and Varun Beverages. Under PepsiCo, they do the branding. They prepare and supply the concentrate so that the formula is with them. They also do the broad level branding and marketing. Varun Beverages in India does the manufacturing, logistics, distribution, and within the store, small promotions are done by Varun Beverages. So it's a very healthy relationship and a perfect business model to work with. When we talk about the product portfolio, these are the products which we consume and see around us every day. We have carbonated drinks like Pepsi, Mountain Dew, etc. Non-carbonated drinks like Tropicana and the other juices, Gatorade. Then we have a packed drinking water which is Aquafina. Then there are certain other soda and energy drinks. They have started manufacturing Cheetos in Morocco. In October 2025, their manufacturing plant of snacks in Zimbabwe is going to get live. So like this, they are expanding into their snacks business outside India because PepsiCo already has another company, their group company, which is doing the snacks business in India for them. So they don't need Varun Beverages to again do it. Apart from this business, which is getting from PepsiCo, they are slowly developing their own brands also, making sure there is no conflict of interest either between the products or between the geographies where PepsiCo is supplying. They are developing some carbonated soft drinks, energy drinks, packed drinking water, and dairy-based beverages. The market share or the revenue share of these products, the own brands, is very minuscule right now, just about 1% or so of the revenue. But going forward, this will also gradually increase. So this is a broad basic understanding of the business of Varun Beverages in very simple language. Now let's look at the stock performance. It has been a multi-bagger stock creating massive wealth over the last 5-10 years, and it rallied up to the 650-700 kind of a range in 2024. But then it began to consolidate, and now it is consolidating in the range of around 400 to 450 levels. But the chart, as you see, has become pretty weak. For more than a year, the stock hasn't given good returns and it is unable to cross its previous highs. We'll discuss the reasons for this in detail going forward. They've done a QIP at 565 rupees in 2025. So if you are a retail investor at right now the price at around 440, you're getting it much lower than the QIP price of 565 where institutional investors have participated. If you look at the chart, this range of 450 to 500 is a very critical zone for this stock to consolidate and take support at. And if the performance is maintained going forward, this range shouldn't break. But if the performance weakens, then it can. Now, this company does their accounting in calendar year terms. So we'll talk in CY rather than FI in this video. So if you look at the revenue in the last 5 years, in CY21, they did a revenue of about 8,800 crores, which increased to almost 21,000 crores in the trailing 12 months. So they've been a good growth from CY21 to 24, but if you see in trailing 12 months, the growth has started to slow down. 5 years CAGR revenue was about 23%. EBITDA has also shown a steady uptrend. In CY21, it was about 1,700 crores, which increased to almost 5,000 crores in the trailing 12 months, which is nearly 3x. The margins have got better. They were doing 19% in CY21, which increased to almost 24% in the trailing 12 months. The return ratios are pretty strong in spite of the company doing massive capex in the last 1 or 2 years. Still, the ROC is nearly 25%, which shows the strength of the business. EBITDA to OPCF conversion 5 years average is nearly 70%, which is also a very strong number. Working capital is very efficient. They are almost at zero kind of a working capital, net working capital days. And it is a net debt-free company, so the financials are very strong for this company. Then what is the reason for the sharp correction in the stock price in the last 1 year if everything is so good? The Q2 numbers were weak. Now people and investor community is doubtful whether the same growth will continue going forward. There is competition coming into the market. So will the market share be lost? So such kind of doubts created in the minds of the investor community. That's why the valuation derating has happened in the stock. And overall in FMCG sector itself, the sentiment has been weak in the last 1 year or so. If you're not a part of a Telegram channel, do join today by clicking the link in the description so that you join the right Telegram channel. We have more than 8,000 people in our Telegram channel. Daily in touch with me. I discuss every day morning the market analysis and some sectoral views, strategy how to deal in the markets, which helps people manage their portfolios better. Now let's talk about the growth outlook of the management. The management still says that going forward, they will continue to grow in double digits. Now you should understand that they are now talking about double digits. So compared to last 5 years, which was more than 20% CAGR, they are talking about double digits. So this is expected to remain in between 10-20% is my guess. The new manufacturing facilities that they have set up are getting operational now, and that effect will be seen in CY26 fully is what the management is saying. Then that will impact the growth of the company. They will keep increasing the product basket and the number of SKUs will go up. They will keep penetrating the under-penetrated areas and increase the distribution network within India as well as abroad. The business outside India is smaller but growing faster at more than 15% every year. The EBITDA margins have improved to nearly 28% in Q2 CY25 and they are expected to be maintained in that range going forward. They will continue to focus on their snacks business outside India, and which will lead to a product mix shift with the snacks and the energy drinks coming in, where the average price per SKU will increase, the realizations will increase, helping the business to grow better and the margins to get better. So overall, the management is sounding positive, but we are not sure whether the growth which they have shown in the last 5 years or 10 years can get replicated in the next 2-3 years or not. Now let's come to the most critical and tricky part in this company. That's the valuations part. It is trading at a 52 times earnings, 8 times price to book, 28 times the EV EBITDA, and the market cap to sales is about 7x. Now in the last 10 years or so, if I see the EV EBITDA, it is around 24 times, which is the average. I am considering EV EBITDA in this because they have done recent capex and the depreciation number is very high in the P&L. Because of the massive growth in the last 5-10 years, consistent growth of more than 20%, the company got an average EV EBITDA multiple of 24 times. Right now it is trading at 28 times. Going forward, the growth rate may be slightly slower than before. So at a slower growth rate, it is difficult that they maintain a premium valuation compared to the historical average. So there is a possibility that the valuation derating which is happening right now may continue a little more. And we may see a little more correction in the stock price unless the company surprises us in terms of earnings, which is a little unlikely. What are the risks of investing in this business? The snacks portfolio the company has not got for India. Otherwise, that would have been a major trigger for growth for this company. So they will be selling snacks only outside India, which are much smaller geographies compared to the Indian market. So if a similar thing happens with other new products in India, that will be a minus point for this company. The growth is slowing down compared to the historical averages. The valuation derating is happening. There is competition emerging from players like Reliance. After their purchase of Campa Cola, they are selling much more cheaper than this. There is competition from new startups which are coming up with several innovative drinks. There is an element of cyclicality within the year, like Q2 was weak because of unseasonal and heavy rains. There is a high dependency on PepsiCo. So although they may not disturb the existing business, but if they don't give new business or new products to this company, that will be a minus point for them. A lot of people are becoming very health conscious, though there is a tailwind in one sense that the tier 3, tier 4 regions have started consuming more beverages. But the people in the city becoming more health conscious are reducing their intake. And outside India, the execution risk is always there because it is not as comfortable as expanding in India for this company. So we have discussed the business model of the company, the growth prospects, the financial numbers, valuation, risks. Now, what is an overall view on the stock? If you're already holding the stock and you've made good amount of money in the stock, this 400 to 450 range is a strong support zone. And if that is breaking and the stock is making fresh lows, then you should protect your profits. You should closely watch the results and see whether the results are weakening. And if the growth is slowing down, then you should protect your profits. If you're looking at a fresh entry in this stock, you should wait and watch for the next few quarters. Let the growth pick up. Let the charts become stronger. Let the valuation get a little more derated. Then see whether the company is able to deliver at least 15% growth going forward. Because growing in high single digits or low double digits, the market may not give it a very premium valuation. So for a fresh entry, you should wait and watch for the next few quarters. Let the charts become stronger. Let the results improve. And let the management give more specific result commentary at or above 15% for you to enter and justify these valuations. So that's about Varun Beverages. I hope you like the crisp analysis. I've tried to cover all the important points in this short video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names in the comment section. Even this was picked up from the last video's comments. Do join our Telegram channel. Thank you for watching and have a wonderful day.